Hi everyone, I'm Elyor, Chief Valuation Officer at altshare by altshare. altshare is a leading provider of equity management solutions and trust services. We're trusted by more than 2,000 companies and VCs worldwide. With me, I have Sebastian, a senior manager at EY, working with Michael Marziano, a partner in the high-tech and insurance field.
Hi, Elyor. How are you?
Great, thank you. Our main topic for today will be stock-based compensation expensing. What does it mean? Who needs the service? The best practices that we have, accounting standards, trends, and of course, case studies. Let's start from the beginning. Once a company has submitted an option plan to the ITA and actually granted options to her employee, the first question is, does she need to recognize expenses regarding those benefits of those options? So Sebastian, when would a company actually start recognizing stock-based compensation expensing?
Good question, Elyor. Well, I think that a startup company that is only starting to grant options, they need to first understand what the requirements for their financial statements are. If it's only for statutory purposes, in most cases, companies don't account for share-based compensation, and as auditors, we supply a qualified opinion, meaning that the financial statements are fairly and appropriately presented, with the exception of share-based compensation, unless, of course, there are additional issues that we basically supply a qualified opinion for. And of course, everything according to the relevant GAAP. On the other hand, if there is a requirement, such as from investors for US GAAP or financial statements in IFRS, for example, even Israeli GAAP, but with an unqualified opinion regarding share-based compensation, then I think that the right treatment is to start expensing the option grant since the accounting grant date, which has different definitions and terms in each GAAP, and we won't get into it now, but I suggest that everyone needs to consult about it with their auditors. And basically it means that you will expense the fair value of the options based on the relevant amortization method. The ideal thing, in my opinion, will be to do it from the beginning, but as mentioned, for statutory purposes alone, most companies don't do it because it has no effect on the tax return and it requires investing time and money.
So eventually what you're saying is every company will need to recognize expenses, but not from the beginning.
Yes, exactly.
So once we will actually do recognize those expenses, there's actually two steps, and a little bit talk about it. First step is actually evaluating the estimated fair value of the option. Today, there are two main models doing that. First one is actually the Black and Scholes model, and the second one is the binominal. Both models are mathematical equations that estimate the theoretical value of the asset or investment. And it takes into consideration many risk factors. What are these factors? The first one is the exercise price, which is actually known as the grant price as well, the price that somebody will pay in order to exercise its option. The second one is the expected term, which is usually the length of time that the grant is expected to be outstanding. The third one is the risk-free rate, which is the rate of return of an investment with a zero risk. Usually you would use the risk-free rate of a bond of the same country, which means if it's a dollar, it would be the US Treasury. In Israel, you would use Galil or Shachar. Usually you don't use them, but hypothetically. The volatility that usually measures past market changes, and it depends most of the time on a peer group, which are similar to the company that granted those options. And in most cases, I must say, the higher the volatility is, also the higher the risk of the company is. And of course, the last one is the market price. So the market price, I will say two words about it. If it's a traded company, we don't have a problem because you actually have the stock price. But if we're talking about a private company, which is most of our cases, you would have to use the 409A, which is actually the valuation of the ordinary share of that company. After doing that first step, the second one will actually be amortizing this expense. There are two main amortization methods, the straight line and accelerated. I won't go into it because I think it's a really just different kind of talk. But I will say it does affect the kind of fund that you're in. So saying that, Sebastian, what is more common actually using the IFRS or US GAAP? And is there any kind of difficulties moving from one to another?
I'm not sure on the statistics on that, but I can say that Israeli startup entities, due to the nature of the investors and the aim to go public in the US, the main preference will be US GAAP. But if your goal is to go public in almost any other market, I think that IFRS will be the preference, including in Israel. I'll also say that regarding the big topics, there are not too many differences between the gaps, but there are some differences. For example, the straight line amortization is not applicable in IFRS, and you need to accelerate the expense. And although acceleration is the default in US GAAP, you can use the straight line method as well in some circumstances. And by the way, following your explanation earlier, as a tip, it's important for me to mention that we as auditors, we also audit the ordinary share valuation, including 409A valuations. So if you are doing a valuation as a company, before you confirm it with the board and grant options based on it, please make sure your valuation was audited. It will ease the process later on, and it will make sure that you don't grant any options with a mistake.
So basically, there is no absolute answer for that, and it all depends on the company's future goals.
Exactly.
What would you recommend to a company to do the whole valuation and amortization and everything by themselves, use an expert? How the use of an expert can actually facilitate the audit process, and of course, taking into consideration all factors, including the notes that you have in your financial statements, the data you receive, and more?
Well, Elyor, I think that it depends on the size, time, resources, and also capabilities of the accounting team in the relevant company. First of all, to do it right, as you said, you need an expert in order to calculate the OPM. Also, if you grant a lot of options, doing the amortization and all required notes for the financial statements internally in an Excel file can be complicated and open to many errors. In good faith, of course, but everyone knows that it's enough to miss a few cells in a sum formula and then go try to find it later on. Sometimes it's due to confidentiality issues that companies don't want to outsource it. But all the information is in the hands of the trustees either way, and most trustees supply today all the accounting and valuation services as well. So I think that that issue was treated. As I said, today, most valuation experts supply also expensing services, which include all the notes and requirements for the financial statements and for the audit as well, even including journal entries. So I'm seeing more and more companies, even small ones, using these types of services from the inception of the share-based treatment. In general, we are seeing a digitalization of accounting tools used by companies, and from our side as well as auditors, we are investing more and more in digital auditing tools. It's a big game changer today. I'll also add that from an audit perspective, if the expert also has an effective SOC 1 report on the relevant system, it will be much appreciated by the auditors as well, because then with some additional procedures, you can rely on the controls of the system, simplifying different IT aspects of the audit, in which for public companies or even companies anticipating an IPO in the foreseeable future, it's very important. So far from what you're saying, using an expert will make your life easier. I will ask you something about what's going in the market these days. Lately, we are aware to more and more cases where companies actually write operation losses or high revenues due to these expenses. Hypothetically, an exit having an acceleration will show many expenses. So how can we prevent this? Or from your experience, how can we take care of this ahead? Well, I think we need to divide it into at least 3 different cases. The first one will be really in cases such as an IPO, for example, in which sometimes some employees have the option to accelerate the vesting of their options afterwards. And then, in some cases, you need to account for a modification and account for the entire expense left. So you will suffer a big hit to your P&L in these situations. I'll also add that in most cases, these employees are officers with material grants, such as CEOs and CFOs. The other case is when many employees leave a company at once, and then you need to account for a forfeiture, which is basically reversing the journal entry of the expense versus the additional paid-in capital. And as a result, you will recognize the big share-based compensation income. Other common cases are when a grantee receives, let's call it, an improvement to their grant, such as a lower exercise price. Let's say it was $10 and now it's $6, in which in such cases, you need to modify the treatment and account for that modification. The accounting term is repricing of the grant. In these cases, I suggest contacting your auditor for accounting consultation. What about from your end, Elyor? Did you see any material modifications lately?
Actually, I did. I think you mentioned most of them, which is funny, but actually say about each one of them that you said. First one, we didn't have an IPO, but we did have an acquisition, and what happened is all the options were accelerated, which made many expenses, but there wasn't a loss, an operation loss according to that, but there were a lot of expenses. And the same thing also with the termination, when a lot of employees actually leave, sometimes what happens is the income is so high that at specific points of time, you won't even have expenses. And that is something that actually happened in many companies, that a whole year, after the whole year, they didn't even have expenses because the amount of reversing was so high. Regarding the last point that you said, the modification of a repricing, this one will usually make more expenses, especially because you have to recognize everything at the moment.
Point in time.
Exactly. But we also have, of course, more modifications that I'm not going to talk about all of them, but the one where you actually change the life term also, the expected term also makes many expenses, and that one we actually see a lot. But yeah, I think the repricing one that you said is the one that makes most expenses because you have to recognize everything at a point and forward.
So I think we'll finish with that. We can talk a lot more about the stock-based compensation expenses, but I think we'll leave that for the next time. Thank you, listeners, for joining us, and thank you, Sebastian, for the conversation. It was very interesting and, of course, enriching, as usual.
My pleasure. Thank you for the talk today.
You can visit us at our website, altshare.com, for more information and, of course, to contact us. And we'll see you next time. Bye.